The US dollar has been creeping up to multi-decade highs while supply chains are pushing up the price of everything, not least of which is the cost of energy. That means outside the wealthiest nations, countries are stuck with rising fuel costs paid for in US dollars, which are also going up, and any debts they hold in US dollars are also becoming more expensive to service. The only country that seems to be doing well out of all of this, or sort of okay, is the United States. A mightier dollar means they can buy more from overseas for less, downgrading the impact of inflation. So they're all right, Jack, but what about everybody else? That's this week on the Debunking Economics Podcast with Professor Steve Keen. I'm Phil Dobbie. Welcome along. Well, Steve, one listener, Pola, has asked, any chance you could talk about foreign debts and how this works, which I think we've sort of done a few times before, but always an opportunity to expand it further. But more importantly, I think she's also saying what impacts are likely to occur as the global south, the BRICs, which is, what's that? That's Russia, India, China, South Africa, what's the B? Brazil. Move to payments in their own currencies instead of US dollars or bartering, which these are both pertinent questions right now. But let's start with the US and the dollar, because obviously this is the nub of the issue. So the US has got a balance of trade deficit, which doesn't seem to matter for the US. I mean, the last time they had a trade surplus was back in 1975. Government debt is also seen, in many countries as a bad thing if you feel like you've got to pay it back. And we've often debated about that. But in the US, the federal government owes, if it is the word to use, quite a bit over $30 trillion in debt issued in treasury bills, obviously, which are owned by banks, pension funds, and a lot of foreign investors and foreign governments. And at the same time, we have developing or emerging nations. I got in trouble for using that word in the last podcast. I don't know, what else are we going to call them? Countries that are not developed nations who are buying in what they need. The problem is, of course, that they are, with a strong dollar, that is making commodities that they want all that much more expensive. So that, they're struggling through all of this. So, I mean, first off, we have to revisit old ground on this, don't we? Because it is the problem is the strength of the US dollar, which is obviously why those BRICS nations are feeling as though, there needs to be a new world order, perhaps. But let's revisit old ground, because this is where Keynes had that idea, wasn't it, for a new global currency. And, perhaps we wouldn't be facing these problems if we had gone down that track.
Oh, yeah. I mean, a major factor that Keynes are trying to do is limit trade deficits and surpluses to no more than 2% of GDP. And if you were running more than 2%, then you'd start running out of Bancors, which is the internationally issued currency Keynes wanted to use for trade. So the basic idea is if a French company wanted to buy American goods and they'd need to convert franc, because we wouldn't have had the euro if we'd gone this way, I think, franc into Bancor and then Bancor into American dollar, and that would pass through the accounts that both America and France had at the International Monetary Fund, which under Keynes' scheme would have been an international bank issuing Bancors to countries in proportion to the size of their GDP. And that would have meant if you exceeded the 2% for too long, you'd start running out of Bancor, and then you'd have to devalue your currency to be able to get more in. It'd be enforced by so it would be a sort of fixed exchange system with a means by which it could be floated, but it would need to be agreed with an international body. But on the other hand, if you're running a surplus, then ultimately you would charge interest on the surplus, and the interest would be used to fund development projects in developing countries. And that was Keynes' idea, to limit it to no more than 2% of GDP.
Right.
Now so what we're seeing throughout the system is deficits and surpluses of the order of 10% of GDP.
And it's got worse, of course, because of the price of commodities. So if we saw, how would the Bancor work in a situation where we are now? So if we saw the price of oil skyrocketing, for example, well, I guess we wouldn't be trading it in the US dollar for a start, would we? So that would
be trading it in Bancor. That's right. Yeah.
So how would that change things? Because I mean, the inherent price would still be going up. So those countries that are not quite as developed, and it's a smaller proportion, it's a higher proportion of their their total income is being spent on commodities. They would still struggle, though, wouldn't they? Wouldn't fix that problem.
Well, what it would mean is, though, that the surplus, if you had a large surplus being run up by Saudi Arabia, then its currency would be appreciated against the Bancor, So the Bancor would buy more Saudi products than beforehand, which would mean those countries with Bancor would have a compensating mechanism for the increase in the cost of oil denominated in that'd be denominated in Bancor, but the Bancor would buy more Saudi, which would effectively make it easier to purchase the oil, even though the price had gone up in the international currency. But also, if that started accumulating a surplus, a persistent surplus for Saudi Arabia, then they would be taxed on that through the scheme that Keynes had as part of the Bancor, and interest being charged on that would be passed to the developing countries. So part of the higher oil cost would come back to them as revenue from the International Monetary Fund, not the one we've got these days, but the one Keynes wanted to bring about. So that would be a compensating mechanism for the scale of the increase in the price of oil as well.
Right. So the Saudis would find that they're getting taxed more because their surplus is too large. That money would be going to the developing nations that would say, well, we really are struggling to pay for this fuel, but then they would have a slug of money that they could be used. I guess the ideal would be that it was used for investment, but maybe in the short term they say, well, okay, we need that to buy the energy for us to be able to survive. And then the Saudis will quickly realize, well, hang on a second, we are charging a lot for oil which is being compensated. We may as well drop the price of oil.
Well, I don't think it'll go that far, but it was an idea to dampen the instability of the global system. Whereas the Americans, this is just one of the great stupid decisions of imperial power under Harvey Dexter White, insisted that rather than the Bancor be the American dollar. And this is sort of saying, before the war it was the British pound, which is the international currency. We're the strongest nation by far after the Second World War, which is correct, of course. They didn't win it, but they certainly were the strongest nation on the other side of the Second World War. Used the American dollar. And now what that meant was, and Yanis Varoufakis covered this very well, that meant you have a demand for American dollars over and above the demand you would have if you were buying goods and services from America. So as well as wanting to specifically buy goods and services from America, you needed American dollars for all the international transactions. So that's caused push the value of the American dollar up, which of course makes American manufactured goods more expensive and then sets in train that it has to run a trade deficit.
Yeah. So actually, it might be better for America in a way if that had happened, because that was going to be my question. What would it really mean to the US if that hadn't happened? Because
they have a stronger manufacturing sector.
Yeah. Yeah.
And that's one. Like, there's one reason I got a couple of criticisms yet again over my attitude to modern monetary theory and international trade. But I'm sorry if I'm facing a challenge between the opinion of modern MMT people and the opinion of Keynes. My bias is going to be also accepting Keynes's analysis rather than more recent supporters. So, and on that front, Keynes wanted to limit trade deficits. He did not want them getting too big. He didn't want big trade surpluses either. And that's seeing the scale of them, whether you're in surplus or deficit, being a destabilizing factor in the global economy, as I think it's proven to be.
Well, yeah, just as an aside on that, maybe we could all just accept the fact that the MMT book is not completely closed, as no book is. There's open debate. There will be inaccuracies and things that need developing further. And if you are a belief that MMT is some sort of cult that can't be questioned, you really are not going to win a mainstream argument on that basis. You're just going to piss a lot of people off. I only mention that because someone had a go at me, and I'm a big supporter of the cause, like you are. And it's funny. It's like we're like the Tory party in the UK fighting amongst ourselves. Doesn't make a great deal of sense, does it? But look, going back to where we are right now, the US trade deficit obviously is great news for the places that are selling to them, like Mexico and Germany and China and Japan and Ireland, strangely, Vietnam, Italy, all have trade surpluses with the US. So, they'd be quite happy with the way things are.
Yeah, and like the MMT attitude is actually quite inverted on that front, because they're saying, these countries that are exporting to America are giving away real goods and getting pieces of paper in return. Silly them. But we're willing to take advantage of that and swap pieces of paper for goods and services. And I really don't want to get engaged in that argument. I just find it rather trivial, because and this is a bit of a diversion as well. But if it's true that exports are a cost and imports are a benefit, then countries should be attempting to run trade deficits. And because the sum of all trade deficits is zero, because we're not trading with Mars yet, So one country's trade deficit is collectively the rest of the world's trade surplus. If that's true, you should be trying to limit trade deficits. And I've never heard anybody in MMT talk about that, just saying it's good to run a trade deficit. Well, yeah, okay, if that's true, what's the total sum? The answer is zero. Well, therefore, if you have one country running a trade deficit and that's good for that country and bad for those running a trade surplus, you've got a beggar my neighbour policy, and that doesn't sound like good international policy to me. So, I really get aggravated about it.
China's got it totally wrong on that basis, hasn't it? Who'd have thought this idea, we are going to ship stuff overseas, we're going to get that money, we're going to use that money to pay people within our country and to invest in
And the poor, immiserated
develop.
Chinese, as a result of it, all these, what they've got is an investment surplus, and they've used that brilliantly to invest and develop their own economy. Anyway, so I think there's a lot of badly thought out elements in that argument. Even if it's correct that it's exports are a cost and imports are a benefit, then that's a reason to have an international rule to restrain trade deficits.
Well, look, there is so much more to this discussion, including the fact that if the world doesn't go down this road, what if certain parts of the world did? What if the BRICS nations took on board the idea of Keynes all those years ago and challenged the orthodoxy around the US dollar? We'll discuss all of that in the full version of this podcast. To hear that, you need to become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof Steve Keen, or you can subscribe at debunkingeconomics.com. Back next week, where we'll be looking at electric cars. Are they the answer to the climate change issue, or are they just a bit of a sideline? That's next week on the Debunking Economics Podcast. We'll see you then.